Patronage distributions provide benefits to cooperatives and member owners. Patronage is member-based profits that are distributed back to those members based on use. That means that patronage is distributed in proportion to business volume conducted with the cooperative. As discussed in a previous video, members can receive patronage in the form of cash or as an equity investment in the cooperative. Cooperatives can use that investment as a way to fund capital expenditures or other projects.
Because of the unique business model of a cooperative, profits generated are only taxed once. Single taxation is another benefit of patronage distributions, which means that taxes on cooperative profits are either paid for by the member or the cooperative, but not both. There are two key concepts that are important to understand when talking about taxes and patronage, and they are qualified and non-qualified patronage distributions. So what is the difference between the two? In a qualified distribution, the cooperative member is responsible for paying the tax on the entire distribution. Regardless if the distribution is 100% cash or a mix of cash and equity, the member is responsible for paying the tax. Non-qualified distributions are different because the cooperative pays the tax initially. When this type of distribution is made, the cooperative holds the entire non-qualified patronage distribution as equity with the member's name on it. Because no cash was paid to the member, the cooperative is responsible for paying the tax. In the future, when the non-qualified equity is redeemed or paid back to the member will pay tax on those funds. At the same time, the cooperative will get a tax credit. The reason the cooperative gets a tax credit is because co-ops are single taxation entities and profits are only taxed once.
In order to make an informed decision on the distribution of qualified or non-qualified patronage, tax rates of the members and the cooperatives must be evaluated. Changes in tax law over time have made non-qualified distributions more appealing to cooperatives. In 1962, non-qualified distributions were introduced into the IRS Subchapter T tax treatment of cooperatives. Very few agricultural co-ops used these distributions because the co-op would have had to pay their tax rate of around 50% compared to a farmer's tax rate of around 34%. In the 1980s, cooperative tax laws lowered the cooperative tax rate to around 34%. In 2017, corporate tax rates were lowered again to 21%, which is below the farmer's tax rate. With a lower tax rate, co-ops have an incentive to distribute patronage on a non-qualified basis.
Let's go through a straightforward example to illustrate who pays the tax. In a previous video on patronage, we showed a board of directors declaring 5 cents per bushel of patronage to be distributed. If a member sold 100,000 bushels of grain to the cooperative, then they would receive $5,000 of patronage. Now, if the board of directors voted for this entire distribution to be qualified, then the farmer member is responsible for paying all of the tax. However, if the board of directors voted to split this distribution 50-50 between qualified and non-qualified, then the member would be responsible for paying taxes on $2,500, and the cooperative would pay taxes on the remaining half. Thus, a benefit of non-qualified distributions is a lower tax obligation for the farmer member.
There are other benefits of non-qualified distributions, including being able to clearly communicate to members who pays the tax. Taxes are paid by whoever has the funds. If a cooperative has the non-qualified distribution, then they pay the tax. If the distribution is paid back to the member, then the farmer member has the funds and they pay the tax. So who pays the tax? Just follow the money.
Non-qualified distributions also provide the cooperative with a future tax mitigation tool. Remember that when a non-qualified distribution is paid back to the member, the cooperative will receive a tax credit at the same time. So in the future, if a co-op has non-qualified equity available and is facing a high tax bill, the board of directors and senior management can form a plan to lower this tax bill by paying back non-qualified equity to farmer members.
In summary, Qualified and non-qualified patronage distributions provide benefits to farmer members and cooperatives. Deciding how best to utilize these two types of distributions will vary across co-ops. Tax implications are very important to consider when making this decision. With careful planning and tax expert advice, a cooperative's board of directors and senior management can determine the best approach to distribute patronage income to their members.